Hey everyone, today we're diving into an interesting topic, how presidential elections have historically impacted the stock market. We'll look at the data on how the market has performed under different presidents and whether electing a candidate from a particular party makes any real difference to the market's success. So if you've ever wondered if presidential elections really matter for your investments, stick around. Let's start with the big question. Does the stock market actually change based on who's elected president? The short answer is yes, but probably not in the way you'd expect. Markets do react to elections, but history shows that the stock market's long-term growth isn't driven by which political party wins. First, let's go over some historical trends. Since the early 20th century, data shows that the stock market has generally gone up over time, regardless of whether a Democrat or a Republican is in the White House. In fact, according to data from the S&P 500, which is a stock index that represents the 500 largest publicly traded companies in the United States of America, the market has averaged an annual rate of return of around 10% over the last century through both Democratic and Republican administrations. That said, let's break it down a bit more. Over the past few decades, markets have tended to perform slightly better under Democratic presidents than Republicans. For example, under President Bill Clinton, a Democrat, the S&P 500 saw an average annual rate of return of about 15%. The economy was booming in the 1990s and the tech sector was thriving, which helped boost stock prices. Now let's look at recent history with Republican presidents. Under President Ronald Reagan, for instance, the stock market also had a strong performance with an average annual gain of about 11%. This period in the 1980s saw significant economic growth, partly driven by Reagan's tax cuts and pro-business policies, which encouraged market growth. So if we look at this from a purely numbers perspective, does this mean that electing a president from one party is better for the stock market? Not exactly. When we dive deeper, we see that factors like global events, Federal Reserve policy, technological innovation, and economic cycles all play a much bigger role in market performance than the political party of the president. Take President Obama, for example. After he was elected in 2008, the market went on to have one of the longest bull runs in history. But it's important to remember that he took office right after the 2008 financial crisis, and the market was rebounding from those historic lows. So while the market did very well during his time in office, it was recovering from a major downturn. Or consider President Trump. When he took office in 2017, the stock market surged in anticipation of business-friendly policies like corporate tax cuts. But in 2020, during his final year, we saw a major downturn due to the COVID-19 pandemic. And this downturn wasn't about politics. It was about a global health crisis. So while both presidents oversaw significant market moves, the argument can be made that those moves were influenced heavily by external factors rather than purely by their policies. Now let's get to the real question. Should everyday investors make decisions based on presidential elections? The historical answer is no. Here's why. Historically, the market has continued to grow over time, regardless of who's in office. The economy and stock market are driven by a complex mix of factors that go beyond politics, such as technological progress, innovation, consumer behavior, and international trade. While election cycles can create short-term volatility, experienced investors will tell you that trying to time the market around elections is risky and often counterproductive. Instead, many financial advisors recommend that investors focus on the long term, keeping a diversified portfolio and staying invested through the ups and downs. So here are a few takeaways to keep in mind during election season and beyond. Tip number 1, focus on your long-term goals. Stay focused on your financial goals. Trying to guess where the market will go based on election results is usually a losing game. Instead, stick to your long-term plan. Tip number 2, stay diversified. Diversification helps spread out risk, making you less vulnerable to market swings caused by political events. Tip number 3, avoid emotional reactions. It's easy to get caught up in the headlines, but remember, markets tend to recover even after major disruptions. Making decisions based on fear or hype rarely pays off. So, does the stock market really depend on the president? The historical data suggests that while elections can create temporary fluctuations, they don't change the market's overall trajectory. The best thing you can do, that I can do as investors, is to stay focused on our goals, avoid panic, and keep a steady, long-term approach. Now, I know a lot of us are in this open enrollment season where we're trying to pick our different healthcare plans. I want you to check out the video on the screen where I talk about the health savings account. This is an important account that I think everyone who is capable of obtaining one should really look into the benefits of having a health savings account. And you want to check out the video on the screen right now. Click on it and I'll see you over there soon. Peace.